starting. All attendees are in listen-only mode.
Good afternoon to our webinar participants today from the Chamber of Commerce. My name is David Thompson and I'm an investment advisor with CCIQ partner Wilson HTM. I'll be the facilitator for today's webinar. Wilson HTM is proud to be CCIQ's wealth management and financial advice partner in 2014, with today's webinar being our first educational event. Wilson HTM is a proudly Queensland headquartered business which was founded as a stockbroker in 1895 and has now evolved to be a full-service wealth manager and advisor to emerging companies. Wilson HTM's core offering remains private wealth management services with a strong emphasis on providing a unique, tailored approach to each individual. A significant proportion of Wilson HTM's private clients are business owners or executives within those companies, and we look forward to further engagement with the business community as a Queensland Chamber partner this year. In today's ever-changing economic, regulatory and business environment, it is crucial for business owners and leaders to remain informed of both global and domestic economic issues. Today, we are fortunate to have Wilson HTM Senior Investment Strategist, John Lockton, to present on the 2014 outlook. The focus of today's presentation will be the global backdrop, including the US recovery, European return to growth, China's reforms and their impact. Then we'll switch to the domestic outlook for the Australian economy with a focus on Queensland's key economic drivers. John will assess these conditions and their impact on financial markets and the investment environment in 2014. Just a quick disclaimer, which will show up on the screen now. We obviously don't know your personal circumstances or what's in your investment portfolio, so please consider any advice in today's presentation to be general in nature. And just a few quick tips for today's webinar. Today the webinar will run for approximately an hour. There'll be a Q&A session towards the end of the presentation, so keep some questions down throughout, and you can send those through by typing the questions into the box. A copy of the webinar recording and slides will be sent to your inbox within 2 to 3 business days. Before I hand over to John, I'll give you all a brief bio on his background and credentials. John's primary areas of focus are equity strategy, security analysis, economic strategy, and portfolio management. John has worked in investment markets for 15 years. He joined Wilson HTM in 2010, and before that spent time at Morgan Stanley, Citigroup, Challenger, and Credit Suisse. He holds a Master of Applied Finance from Macquarie University, a Graduate Diploma in Applied Finance from FINSIA, and a Bachelor of Economics from Newcastle University. Over to you, John.
Good afternoon, everybody, and thanks for having us along on this webinar to go through what we think is likely to happen in 2014 in terms of financial markets. And as Dave said, yes, I am a purveyor of the dismal science for all those years ago back at Newcastle University. So what we'd like to do today is really have a look at what some of the big global themes are, which we think are really important to look at for their implications here in Australia, implications here locally in Queensland, and what that may mean not only to your business and businesses you interact with, but also in terms of investing and what we think some of the implications are for your investment portfolios or some of your potential clients which you're dealing with in the business world. So apologies as we go through this, because I look at global markets very much with a set of investment eyes rather than the eyes of a government official or policy maker or a corporate. I'm looking for opportunities at which the global market throws up, and looking for opportunities which are thrown up locally on the back of big global themes. So it's just a little bit of I guess a health warning in terms of how I will be presenting, or my angle on how I look at these some of these big trends in financial markets. So I'm on slide 6. I'll refer to the page numbers as we go through the presentation, and as David suggested, more than welcome to take questions at the end, but also feel free to submit questions as we go through, and we'll do our best to answer those as we go through the next half hour or so. So what do financial markets hold in 2014? Look, we think the bottom line is that financial markets are going to improve, particularly economies in the Northern Hemisphere, whether that's in the US, in Europe or in China. We think 14 is going to be a better year than what we saw in 13, and we'll run you through some of the reasons why. We also think Australia remains poised in a relatively delicate, balanced situation. Some of these global themes are impacting us here. We've also got a few issues locally we need to step over. And the RBA, we would argue, has played its hand. So we remain in a period of transition here locally, and for investing and for activity levels within businesses, we do think we're going to see a very modest recovery take place as we go through this year, particularly into the second half of 2014. And for investing, we still firmly believe that the backdrop remains pretty constructive for investing, particularly what we would call risk assets. So we still think that making the flight to safe assets, whether that's bonds or whether that's cash, is probably the wrong thing to be doing at the moment. We need to be chasing higher returns because not only are valuations suggesting that is the way you should be looking at investing, but also the potential returns point that way as well. When you've got cash at 2.5% from the RBA, you've got term deposits at 3 or mid-3s at best, and you've got equities which should be capable of delivering high single-digit, low double-digit returns. It makes it quite hard as an investment professional to say, look, cash is really where you should be overweight and fixed income is really where you should be overweight. It's not our core view at all at this point of the cycle. So far in 2014, and again I'm still on page 6, we have seen markets offshore, refer to the US, reach new highs. We have seen increased volatility both offshore and domestically. Equity markets provide a key barometer looking forward to how real economies could potentially perform. And one of the risks or one of the issues that we've seen debated in markets this year has been what's happening in emerging markets, so those developing nations, much smaller, more volatile, much faster growing. What happens as we go through this year when we have a key change in policy happening in the US? So we'll touch on that in a moment. In the US, this remains perhaps our most, I'd say from a strategy perspective, it's probably our easiest call, which we have on the deck at the moment. The recovery in the US we're very comfortable with. We think growth can accelerate and print north of 3% this year. It's the one we don't lose too much sleep on. Europe also we think is going to be better, but rather than 3% growth rates, think 1.5. It's not a great number, but it beats 0 or it beats a number with a negative sign in front of it, which is what we've seen for the last 2 or 3 years. Emerging markets, the big change in policy we're seeing right before us in the US with what they're doing on interest rates and monetary policy is having flow-on implications and flow-on effects into the emerging market. There are some fears out there that this could unravel global growth. We don't subscribe to those fears, and I'll run you through some reasons why we think that view is incorrect. And then, as I said, here in Australia, we think the RBA has largely run its course. Inflation is well anchored. Growth is starting to improve. What are the 2 key things we're watching? First is the short term, the federal budget now in May. First federal budget by Hockey and Abbott. It's likely to be a tight budget. Just how contractionary it will remain of great interest. We'll remember back to 97, 98 under the Costello era, it was quite a contractionary budget. Why are we so focused on it? Because growth is still pretty soft in Australia. It's sub-trend, and we would argue that it's the wrong time for the government to be stepping out in a big way out of a source of growth in Australia at the moment, particularly when we've got this transition going underway at the moment between companies investing in new infrastructure, whether it's Gladstone here in Queensland, Northwest Shelf in WA, etc. You've got a significant amount of investment going on, and that is all coming to an end over the next 2 to 3 years. So a transition from investment to reaping the returns or harvesting the returns on those investments can often threaten growth rates in Australia, and that's what we're debating and we'll have a look at through the course of the presentation. Employment remains pretty soft in Australia, and that remains a key focus of ours, to our view, that we don't think rates are being cut. If we were to see that level of unemployment creep up or step change up through 6.5% to 7.5% or 7%, then we would firmly be of the view that the RBA would have to come back into action. So, look, bottom line, in terms of where we're travelling today, we do expect a better global growth backdrop. We do expect Australia to start to point to more concrete signs of higher growth and better conditions as we go through this year. We're certainly not going to take off, but it's going to be a grind to better conditions, if you like. And for investments, as I said at the opening, still remain very firmly of the view that cash, safe investments, if you like, risk-free or close to risk-free investments, largely remain the wrong place to be because they're expensive and you're missing out on the potential returns that more risky investment like equities can provide at this juncture of the economic cycle. So let's go through, I guess, a helicopter view of the world. We'll go round the major regions, starting globally, and then into the US, China, Europe, and then into Australia, just to give you a bit of a view of some of the big drivers or flavours of growth out there at the moment and how that's going to impact markets. So I'm on to page 8, and you can see here forecasts for global growth and the major countries beneath, or the major components of the global economy. World economic growth accelerating. Our forecast is to just under 4% at 3.8% this year, up almost a full percentage point on 2013. So that's not a bad outcome at all. Most major economies, as you can see there, are going to be facing higher levels of growth in 14 than what they saw in 13, which should be good news.
And John, just on that slide, is the accelerating growth in the UK and Europe a surprise? I mean, a year or two ago, things were looking pretty grim with the likes of Greece and the European banking system.
It's still a surprise to some. We've been calling the turnaround in Europe now for well over 12 months, but it is a really, really soft turnaround. We're talking 1.5% growth points, and the big driver of the European turnaround is really less austerity, so less tax rises, less government cuts. That's a driver, and if we're right on our global growth call, Europe's a material exporter of product and services to the rest of the world. They'll get a benefit on the export side. But whilst we're calling a turnaround, it's anemic at best. The UK, similar comments, with the big advantage that the pound has depreciated, which is great news for pommy businesses when you've got a lower currency. So this is slide 9, just a quick summary of some of the themes, some of which we have touched on in our rank of where the risks lie. You see the traffic lights on the right-hand side. The good news is we don't have any red lights, i.e. red signals what we would think is a worse year in 14 than what we saw in 13. We see that global growth can improve, less austerity, better external demand. There's only so long in a modern industrialised economy that you can keep deferring purchases, whether you're a consumer or a business. You can't just not invest forever, and we're starting to see evidence of that, particularly in the US, where business investment has been poor now for 5 or 6 years, and that's starting to return. Monetary policy, again, central banks, particularly in the developed world, remain very much focused on providing high levels of stimulus, low interest rates, quantitative easings, or in layman's terms, printing money. We'll touch on that in a moment, but those policies are still in place and largely likely to be in place as we go through this year. So again, we're seeing support there on the monetary policy side. Fiscal policy we've touched on, less austerity, whether that's in Europe and or the US. Some will say, John, just be careful of what happens in the federal budget here domestically. But again, we're seeing language out of hockey, and particularly over the weekend as he hosted the G20, the importance of investment to drive productivity and to drive further growth. And for markets, we suspect that bond yields will gradually grind higher this year, but not enough to rock the boat, not enough to bring question marks on whether higher interest rates are going to unwind any economic growth story. They will grind higher, but not enough to unwind the performance of equities, in our view, or derail global growth. So that's a quick global recap of some of the differences we expect to see in calendar 14 relative to what we witnessed last year in 13. And perhaps the most interesting one, and the one which is going to get the most amount of debate this year, we think is going to be on monetary policy or interest rate policy from central banks, particularly from the Federal Reserve, the US's equivalent of our own RBA. And what I've tried to show here graphically is just how much money has been printed, if you like, since the onset of the GFC 2007-2008, and just the significant expansion in balance sheets right across the developed world, whether it's in the US, Europe, Japan. Significant. We would go so far to call it as a monetary experiment, i.e. the size and quantum of this has never been done before, and how this is reversed or normalised still remains a question mark. So that expansion in the balance sheets, it's roughly the size, just to give you some context of what the numbers mean, roughly the size of half the US economy. So one of the themes we'll see this year is discussion of the Federal Reserve tapering or reducing its program. It's currently spending 65 to 75 billion a month buying assets. That's going to be wound back to zero, and then that will have to be withdrawn at some point. But this year remains all about what we think at this point is a relatively straight line, reducing the size of the asset purchase program down to zero by about $10 billion per month or thereabouts. And it's going to take a reasonably forceful change in the wind, if you like, in the US, I think, for the Federal Reserve to change from that stance. They want to provide some stability. So slide 11, with interest rate policy, if you like, becoming not as loose, not as, I wouldn't say it's going towards a restrictive stance by any stretch of the imagination, but the aggressive looseness of that policy being unwound as we start the year. We've seen repercussions globally, particularly in emerging markets, so more volatile, much smaller markets, and we've seen, if we just look at share prices as an indicator or a barometer of what investors and market participants are thinking, we can see that there's been some quite dramatic performance or underperformance, particularly of emerging markets, particularly when you go to some more exotic locations like Latin America, that's predominantly Brazil. We've seen some dramatic underperformance, particularly when you contrast that with what's happened in the US. Slide 12 just touches on that. This remains a key risk in our view to the recovery this year. Bottom line is we don't think the potential issues in emerging markets are as severe as what they were in the late 90s, 1997. Some of you will remember the Asian crisis here close to home. Emerging markets are important for growth. If we look over the last 5 years or so, they've contributed about 70% of global growth. So that is, of all global growth, 2/3 of it, if you like, is coming from the developing world. The 5 most vulnerable emerging market countries, which we keep a watch on, the popular press is referring to them as the Fragile Five: Brazil, Indonesia, India, South Africa, and Turkey. And what do they all have in common? Obviously, they're quite geographically dispersed and have quite different natural endowments, but what they all have in common is that they all have some relatively significant structural issues, which to a large degree they are not fully on top of, but they also have a large requirement to borrow from the rest of the world. So they all have large current account deficits. And that makes them vulnerable to any move in the price of their foreign debt obligations. So as their currencies potentially depreciate, that increases the cost of that debt service, which can bring all kinds of question marks to their local economy. And if the central banks go and defend the currency, we all know what happens when central banks start lifting interest rates. We know from our own business experience that when central banks start lifting interest rates, even the RBA here in Australia, it makes things tougher for local businesses.
And John, just a question here. The Fragile Five, we haven't included China or Mexico. We're comfortable with their growth outlook, and at this stage they're not exhibiting the signs of concern these other countries are?
No, not at all. Particularly with China, it's not. It has foreign currency surpluses, so it doesn't have the indebtedness which those Fragile Five do. It's also got structural challenges itself, but it doesn't have any of the key issues which are a concern on the Fragile Five. And likewise with Mexico, similar comments there. Remember, Mexico is also a very small contributor to growth. Some would say it's the benefit of a planned economy that government spending can provide some stability. But bottom line is, neither of those two nations should be caught up for the same reasons here. They have their own individual characteristics and issues we need to keep on top of. I'm going to skip over to the US, and we'll go through the US in terms of what that means. So we're on to slide 14 and 15. I said at the start of the presentation, the US is the region of the world where we're most comfortable with our views. We don't see the risks as being overly burdensome for calendar 14. Looking at a large range of indicators, you come to the conclusion that there is a recovery happening in the US. It's just not as strong as what many of us have been used to. And here is Exhibit A, if you like, of the employment situation. And the red line is the line to focus in on. That's the employment loss since the onset of the GFC, 2007, 2008. So all I've done here is just measure the number of employed people in the US, convert it to a percentage, and look at the decline. They cut 6% of their workforce, which is huge. Your typical modern post-war era recession, if there's such a thing, generally sees corporates shed 2 to 3% of the labour force. Here they shed 6. So, you can certainly see why some people said this was as significant as what we saw way back in the 1930s with the Great Depression. But the good news here is that look where that red line is now. We're almost back at zero, i.e. we're almost back to the same number of jobs in the US economy as what we had in 2007, 2008. Of course, the flip side remains there's more people in the US now. They actually do have relatively decent population growth, and there lies one of the many challenges still before the US is that line needs to go well above zero. But the trend is definitely moving in the right direction. In terms of US housing, again, another undeniable trend in our view. You just simply look at prices as an indicator. Prices often give you a leading indicator relative to activity levels, and we've seen prices across the large capital cities in the US up circa 20-25% off their lows. And the chart here I've just simply illustrated, because I think it's one many of us can relate to, is just looking at what happened to mortgages in the US, how long were they underwater, i.e. how long was the value of your house below what you owed on it. And you can see it's just in the last 6 to 12 months where house prices have actually gone above the value of mortgage debt across the US. So think about your own situation, and if you're paying off a mortgage and suddenly that mortgage is worth more than the value of your house, it's going to have a pretty powerful change on your habits. Flip side, when it goes the other way, likewise, you're going to start spending more, and that's exactly what we're seeing in the US at the moment.
John, just how important is housing in the USA to economic growth? They talk about housing as a multiplier, with construction being jobs intensive, furniture stores, real estate agents, many other industries which do benefit from housing and construction growth. Could you give us some colour on that?
Yeah, we think that the US housing, and broaden it a little bit to constructing as well, can probably contribute around 2 percentage points of growth, which is pretty meaningful, particularly when it's been a detractor from growth over the last 5 years. And that 2 percentage points is not the size of the US housing or new housing market. That's, as you were articulating, David, that's the multiplier. So everything from new SUVs through to new furniture, through to the services which are all associated with building a new house. That trend we think could continue for at least the next couple of years in the US. So the US is the region of the world where we're most comfortable with the outlook, the one where we don't lose too much sleep on at night. Let's go across the other side of the Atlantic, have a look at Europe, what's happening there in terms of growth. We mentioned at the start of the presentation, this is slide 19, that Europe was improving. That's right, but it's improving at a really slow pace. It almost feels like you're watching a glacier slide down a ravine. Look at the growth numbers, quarterly growth numbers of 0.2s and 0.3s. It's hardly very strong at all. And when you then start to look at annual growth rates on the right-hand side of that chart there, growth rates of 1.5%. The good news is they printed minus 0.4 last year, so going to +1 is a pretty decent turnaround. We see that there's 3 key drivers of that this year. Firstly is less austerity, so that's less tax rises, less reduction in government expenditure. Most of those programs are well underway and are starting to be phased out. The second is global growth should lead to better export growth. A lot of European multinationals export product to the world, particularly into Asia. And with better external demand, that should also help the trade exposed or the exporters in Europe. And then thirdly, you've got to be careful how you look at this, but inventories in Europe are relatively low, i.e. there's not a lot of stock on the shelves in factories or in the retail channels. There's a real potential that inventories can be built further, and that's obviously good news for growth in the short term. So bottom line is there is a very soft recovery happening in Europe. We do not believe that the Eurozone is going to fall apart. Those fears which many were talking about 2 years ago, we think remain still unfounded, but we don't think you're going to get a snap back to 3 and 4% growth levels like we've seen in the US. So coming a little bit closer to home, let's have a look at China and what's happening there, because last year was a fascinating year in China. We had a growth slowdown, printed at the end of the period 7.8%. I say a slowdown because we were doing 9s to 11s if we go back 2008, 2009 and 10, etc. So a slowdown there, and we would argue at least half of that slowdown was a premeditated directive from policymakers. 2013 saw the new administration come into play into China with revelation of their new 5-year plan, which is largely going to address some of the issues and emerging structural issues China has, whether it's with the environment, whether it's with the returns many of the fixed asset investment projects have, whether that's railroads or apartment blocks, whether it's the lack of representation of consumption in their GDP. All those types of issues which we've seen debated almost ad nauseum in the popular press and also financial press, policymakers are attempting to get onto that. It's not going to happen overnight, but it will take some time. But the bottom line is we think that policymakers are able to orchestrate Chinese growth to print in that 7 to 8% range over the next few years. and we see potential upside this year as some of the deregulation starts to go through, and what that means, particularly for private sector companies, which have been a big source of growth in China over the last few years. That means here, slide 22, here for us in Australia, we still see that there's going to be demand for many of the products which we sell, and increasingly services into Asia and into China. Materials obviously remains the first point of call, whether it's iron ore or coal, and you can see that reflected in the iron ore price at the moment, still materially higher than where our long-term average price forecast is based, which is around 85 to 90 US dollars a tonne. And the reason the price is higher than that is simply because demand remains strong and supply is yet to fully meet that that demand. But the bottom line is we think that commodity prices as a general basket are likely to be flat this year rather than rocketing away, even on the back of stronger growth, because just about every major miner in the world is focusing on increasing output as to what shareholders are demanding, increasing output and increasing cash. We've seen that through the results periods with our own BHP and Rio. So finally, on China, I've mentioned the transition, the 5-year plan, which is now out there, and they're looking. They're now in the implementation phase of that. Deregulation, we think, is a real bull point for China. Why? Because it will play to the hands of the private sector, which is vastly more efficient than particularly the state-owned enterprises, and in our view will address some of the key concerns the bears on China have, particularly with borrowing, leverage, and you know, at a headline level, some of what you call the white elephant projects, which you see there. So deregulation is a key, and you can see the chart there. Historically, the private sector grown at a materially faster run rate than state-owned enterprises in China.
John, they talk about 7% in China as a slowdown or slow growth. I know many first world economies who would love to be growing their economies at 7% per year. Thinking about China, there's obviously been a lot of growth over the past 10 or 20 years. Growing China at 10% a year back in the early 2000s, we're actually growing from a much larger base now because of the growth that has come through over the past 2 decades. Is growing at 7% much more meaningful now because the base value has increased in China?
Yeah, to a degree. That's right. But also remember, some of the detractors, if you were to put that argument all the way through, is that they want to reduce the resource intensity of their growth, so become more efficient at how they drive their growth. And the bigger driver of growth going forward in China is going to be service-related activity rather than fixed asset or, you know, hard construction, railways, buildings, etc. So you're partly right. Yes, base effect is important, and you can see that through the quantities of, red dirt and black dirt here in Australia, iron ore and coal, which are being exported, still growing. But in terms of whether we're going to see the breakneck pace which you referred to earlier, I'm not of the view that 7s, 8s or 9s in China will deliver what we've seen.
And John, just one more question on China. It is Australia's largest trading partner. We've seen the resources sector get huge benefits from China. With this move to more private sector growth and consumption growth, will we see the services and consumer goods companies in Australia get some more opportunities in China to grow over there?
It's a huge opportunity for service-based companies here in Australia. We're seeing the financials push into that place. Australia has a very robust financial system. We have a competitive advantage in it, whether it's wealth management or banking or assurance services through etc. So yes, there does remain a big opportunity there. It's going to take more work than just arriving with a boat full of dirt, so to speak. But that remains a key potential for Australia and for many of the businesses, you know, here in Queensland or right around the country. Tourism is probably one really identifiable one. You know, a large number of Chinese have had significant increases in their own wealth over the last 20 years, and they love to travel to safe, desirable places. And we seem to tick the box on most of those. So the answer to your question is yes. So what does that mean for Australia? Slide 24. I've described it as a delicate transition, and I'm really referring to some of those themes David was questioning or asking questions on, is that we're in a period now where we think that the RBA has played its course, 2.5% on the official cash rate. We think that is as low as it gets and will be on hold all through this year. We're also aware of the transition the country is making in terms of the drivers of growth from investment-led growth to consumption, and I refer to the significant expansion in investment expenditure over the last 3 to 4 years. You only have to look at the amount of dollars being spent in the Pilbara, Northwest Shelf, Darwin, LNG, and then obviously closer to home here in Brisbane, the LNG projects in Gladstone, all multi-billion-dollar projects which have been driving growth and at this point are not providing any returns on that. So as we go from investment to what I call the harvest phase, where those assets are built and we start seeing dollars in, that transition phase often creates a period of really soft growth, and I think we're seeing part of that at the moment. But we're also facing, as many of you will be aware of in business, we're also seeing some of our competitiveness being eroded away predominantly, or partly I should say, by the high Aussie dollar. And you can see here we've been a little bit wider in just measuring the Aussie dollar, looking at the trade weighted index, so really just looking at the value of our currency versus the basket of countries which we trade with, a 40% reduction in competitiveness. So no wonder some of our trade exposed industries, our exporters have had a bit of a tough time over the last 3 or 4 years, and it's a reason we think why the employment rate remains drifting up and why employment conditions remain pretty soft. That competitiveness needs to reverse, and obviously the Aussie dollar is going to be the key driver to that. Slide 26, our forecast for the terms of trade, or another way to put it, our forecast for the Aussie dollar, we see the Aussie dollar going to 85 cents by the end of this year, and we see long-term value somewhere between 75 and 80 cents on the currency, and that will help. We've seen some help already. The dollar was 105, 110 18 months ago. We're now in the early 90s. It needs to do more, and we're going to see more, we think, from the RBA in terms of the commentary, or what we term the jawboning of the currency, rather than firm action. So downside risk to the currency on the back of the currency being overvalued and the US Federal Reserve tightening or reducing its amount of liquidity in the market. So there's the unemployment rate. I've used a more generous measure than the headline rate, which is, call it early sixes on the headline rate. Here, if we measure the underutilisation rate, we're effectively back at where we were 2008, 2009. So it's no wonder when we look at consumer confidence surveys, it's somewhat lacklustre, and in many pockets of the economy, things still feel pretty tough, because they actually are. We suspect that some of the forward indicators suggest that things are starting to improve. The official statistics at this point haven't picked that up, so either our forward indicators are wrong, or the job market is still extremely soft. But with better conditions globally, stable commodity prices, the Aussie dollar coming down, the weather being drier than what it has been, to us it all suggests that there is early tentative signs that the employment situation can start to get a little bit better as we go through the second half of this year.
John, many businesses would have been in a cost-cutting phase over the past few years. So a lot of people probably haven't looked at the employment market for some time. Looking back in 2007, 2008, it was very hard to get staff, and you were paying higher rates to get them. Is it easier now, do you think, for businesses to look at employing people?
At a very macro level, the numbers would suggest that the answer is yes. A pool of unemployed people suggests that it is easier to get staff, and it does put downward pressure on wages. We're certainly seeing pretty soft wage growth across the nation. But as you know, when we speak to any of our clients or business people we deal with, it's not so much the size of the pool, it's the quality of the pool and who is appropriate. And that still remains a challenge for Australia in many industries, whether it's resources or energy, financial services or education. So the mix is just as important, and what that underutilisation chart hides is that, as we all know, the longer you are without a job, the harder it is to get one and the less valuable your skills become. And that remains, that needs to be a clear focus of policymakers, we think, to try and reverse some of those trends. So Queensland, how is Queensland holding up in this situation, and what does it look like for 14? Well, the good news is for 14 we think growth is going to be better than what we saw in 13. 13 was pretty anemic growth here in Queensland, final demand at about 1.8%. We saw housing contribute, so consumption okay. Investment remained really strong, 1.2 points of growth coming from investment, so thank you Gladstone. And the government doing the exact opposite, subtracting about 1.3 points, so Australia's own austerity program, if you like. So this year we think growth is going to go back to about 3% here in the state of Queensland. Again, sub-trend, i.e. Queensland was used to printing numbers of about 4.2, 4.3 is the long-term average. So it's still sub-trend, but off the floor to what it's been over the last 2 years. So that's the backdrop. If we look at a number of leading indicators, and surprise, surprise, they're all largely related to interest rates, leading indicators do suggest that there is early evidence of a turn here in Queensland. Consumer confidence is not a lot below the national average, kind of similar to where it's been over the last 5 years, but some early signs it's starting to pick up. The highest quality signals we're seeing are in the housing market here in Queensland. Finance approvals are well up off their lows, circa 25% here in Queensland since the GFC lows. Even southeast Queensland improving. The standout is here in Brisbane, in the inner city, where we've seen housing approvals up about 100% off their lows. So there is a response from Queenslanders to low interest rates and the expectation of things getting a little bit better. And you're seeing that in valuations, and the backdrop here in Queensland, particularly in Brisbane, when you talk residential property and what kind of activity levels we could see there, vacancy rates remain low, 2.5%, well off the 4% lows that we saw during the GFC. And for the first time in about 5 years, we've got a better potential return in terms of rental yield in Brisbane than we have in Queensland. So again, that suggests that investors would be drawn to the Brisbane market, and I think we're seeing very early signs of that. If I just put my hat on and think what we saw through the reporting season of major corporates, corporates from everyone from Boral, BlueScope Steel, Stockland Group, all commenting that they thought that there were emerging signs that Queensland had bottomed, tentative signs that things were starting to improve. And a few charts here which I'll leave you to go through, just illustrating where we see some of the potential turnaround. Chart 30, housing approvals, you'd see the dramatic increase, and it's not out of the realm of possibility that that increase has materially further to run when you look at what's happened in prior housing cycles here in Queensland. Just touching on the Aussie dollar and what that could mean, we've seen the Aussie dollar do two things in terms of the tourism industry. One, locals are more happy to holiday at home, in part driven by, again, good weather over the last 6 months. But we're also seeing tourists, whether domestic or international, staying longer, which is obviously a key focus for tourism operators up and down the coast. So again, two really clear signs, we think, housing and tourism, which are showing signs that things are starting to improve. Things are different now than what they were 12 months ago. They're early and they're not uniformly widespread, but they're the types of signs we should be looking for when we look forward into 14 and into 15.
And John, just on the Queensland economy and the tourism there, I believe we're looking to build up to 3 new casinos. I think we're largely chasing the Asian or particularly Chinese tourists. So at least I think there's some private operators who are fairly comfortable, such as Crown Casino, for example, that we might see a fairly good uptick in the tourism arrivals from China, should we get the offering right?
Yeah, that's probably the biggest, one of the large opportunities, you know, as Chinese goes into a middle class nation, that you're going to see the propensity of Chinese to travel and travel further afield increase. And, you know, product is always an issue. What type of product do we have down here to cater for those different tastes? So, yeah, I think you're going to see particularly private sector start to invest to attract higher numbers of wealthy Chinese and, for that matter, Asians into Australia, and that obviously remains good news for Australia. So putting it all together, look, slightly better outlook here in Queensland, looking into 14 and 15. The outlook for Australia is in transition. We'll get our next read on those investment numbers Thursday this week, and that remains a key debate within financial markets and remains a key debate within government policy and central bank circles as well. As we see it at the moment, we think interest rates, this is slide 33, remain on hold through this year, meaning that there's going to be very little difference or movement, we suspect, in mortgage rates as well. And we would argue that for investment rates, i.e. term deposits, the strong competition and hunger for deposits from the banks is waning, and we would think that there's downside to those term deposit rates as banks no longer have to price as aggressively of what we've seen over the last 2 or 3 years. So implications for financial markets. We're on to slide 35. So there's a lot of moving parts, obviously, globally, and it's not always a clear picture of whether our view is going to prove to be correct or incorrect. And what that means is that we suspect that the higher levels of volatility, which we've seen in equity markets globally and in Australia, which is the chart I used to illustrate the point here on slide 35, we think volatility is still going to remain somewhat higher this year than what we've seen pre-GFC years. And we saw some of that even since Christmas. We saw almost a 5% sell-off in the Australian stock market on those emerging market concerns, only for it to be promptly put right back on through the reporting season phase over the last 2 to 3 weeks, if you like. So volatility is going to be there. Obviously, it's going to create opportunities and challenges. But one of the points which is emerging as a materially different story to what we've seen over the last 3 years is on slide 36, earnings upgrades. And what I'm looking at here is looking at the expectation the market has of the direction to which forecasts of listed companies are going. Remember, share prices aren't backed by the current level of earnings, they're backed by the future level of earnings, or what investors think is likely to happen in the future. And for the last 3 years, investment professionals have been constantly downgrading Australian expectations around Australian earnings, resources, bank stocks, industrial industries. And some of you will be able to feel that yourselves, whether you're a tourism operator or an area which has been exposed to government spending. You've seen activity levels soften. What we're seeing now is a reversal. We're seeing expectations of future earnings start to increase, and they're almost about to go through zero, through that zero line, that ratio of more upgrades rather than downgrades. And that is very encouraging sign and highly supportive of valuations in the market at the moment. We would like to see that line continue to print higher. We think there's a large number of reasons why it can. So that's a key area of focus for us as we go through calendar 14. The most recent temperature, if you like, or measuring that theme is happening right now with the results season, and we're just seeing slightly more upgrades to downgrades through this results season, particularly when you look at some of the big corporates, whether it's CBA, Telstra, the resource companies particularly, have all printed pretty strong results. So what does that mean for the stock market? The stock market's obviously performed very well in the last 2 years. Last year delivered just over 20% when you add in capital growth and you add in dividend yields. So an unusually high level of total return. In the context of total returns in Australia historically being in that 9 to 11% range. Valuations are slightly above the long-term average. You can see that here in the price-earnings ratio. So it's a ratio which measures how many years it takes for a company's earnings to pay for itself, if you like. The ratio remains slightly above the long-term average, but with the prospect of higher earnings growth to come, we believe that earnings can grow into that valuation, and particularly relative to other asset classes, equities still look a standout in our view. So investment implications, slide 40. So this is really just a wrap-up of what we've discussed in terms of those global themes impacting how we invest in the outlook. How are we investing on the back of this macro view and what we see globally? We still remain cautious cash. We find it hard to recommend to clients to hold big overweight positions in portfolios in cash simply because the returns are so low and the opportunity cost of those returns is so high. Likewise, when you go to bonds, you're getting, high 3s, low 4s at best. We don't see bond yields rocketing away. Inflation's well anchored. So again, we don't see a lot of joy in bond yields in terms of providing good returns in 14. Equities, we remain positive on equities, even despite of where near-term valuations are, partly because bond yields are still low, but also because we see the prospects for better growth and better earnings ahead. And we actually see the prospects for international-based investments as being higher than what we see domestically. Two things: you've got a stronger outlook globally in 14, particularly in the US, than here in Australia, and you've got the potential for the Aussie dollar to come back to, our forecast is 85, but to come back to 80 cents longer term, and those two things should deliver outperformance when you invest internationally. Of course, you can get exposure to that here domestically through some of our international exposed companies. So, conscious of time, Dave.
Thank you, John. We've received a few questions through already, but I would like to invite you to send through your questions on any topic that's been covered today, and John will answer them as best he can. Keep in mind that we don't know your circumstances, so all advice will be general in nature. While you send your questions through, I'll just give a brief overview of Wilson HTM to anyone who missed it at the start. This slide just illustrates our different divisions within Wilson HTM, and they all are quite important to end client outcomes, particularly our equity research team, which John's a part of. We cover over 250 companies, as well as having economic and tactical asset allocation research. As well as that, we have a corporate finance team who do IPOs and capital raisings, usually at a good discount to prevailing market rates. Just a bit of background on the private wealth offering here at Wilson HTM. The stockbroking and investment advisory service has been our core service for over 100 years. So clients work in partnership with their dedicated Wilson HTM advisor to construct an investment portfolio tailored to their unique objectives. So clients will be involved in the decision-making process whether it's stock selection, portfolio construction and tactical asset allocation. We're a strong believer in a strong financial plan as part of an investment strategy. We do have a contingent of financial planners who do assist with that. We have a discretionary private portfolio management option. That's for clients who don't have the interest in being involved in the day-to-day decisions or discussions around stock selection, and an authorised investment manager will manage your investments within agreed parameters to your unique circumstances while providing regular investment updates. And finally, our sophisticated investor program provides access to exclusive opportunities such as the institutional placements and capital raisings I mentioned before, and usually done at a decent discount to the previous market price. Okay, with that, we'll launch to the question phase. Just a quick reminder that you'll get a copy of this out in the next 2 or 3 days, and you'll also get a few special offers for the webinar attendees from Wilson H. Tim as well. Okay, John, we've got the first question through here. Are you expecting negative pressure on equities due to retiring baby boomers beginning a long-term trend of cashing in their superannuation?
No, not essentially. It will change the desirability of equities and I think corporates in terms of whether they pay out more of their profits in terms of income, in terms of dividends. But essentially, no, I'm not a subscriber to the argument that just because baby boomers are all going into the drawdown phase that suddenly equity markets need to be 10-20% lower. I don't subscribe to that view at all.
Okay, next question for you, John. If we see an Australian dollar fall, what is the impacts for tradables inflation and subsequently on interest rates? Just a note here from the question asker. So non-tradable inflation, that's things like power costs, have been running quite high recently, and a falling Australian dollar could be a shock to the CPI.
Yeah, it's a correct observation. Non-tradables has been running at almost 4% now for a good number of years, and the government-related prices have been the key contributor to that. The tradables inflation, there was a modest pickup in that in the last quarter, but really the main impact of a lower dollar is all yet to come ahead of us. I think the key implication is what does it do for policy? Does tradables inflation represent a threat to our call on interest rates? The bottom line is the RBA has in the past looked through tradables inflation to the degree that it thinks that that does not spill over into other areas. So I suspect they will do exactly the same this time. Stevens will look through a higher tradables number, and unless he views that as creeping into wages, then it's a policy neutral event.
It didn't seem that many car manufacturers decreased their prices when the Australian dollar was going up, so potentially we may not see increases when it's going down. Next question, and keep your questions coming through. Another question here for you, John. Do you see a problem with the housing market being driven by investors as opposed to first home buyers? And we've certainly seen some articles to that effect recently.
Yeah, so first homeowners or first home buyers in many states still remain at depressed levels, despite, on many metrics, valuations looking attractive. Just simply the simple ratio of income to the deposit you need and income to the price of the house just remains challenging for many people. Remember, a key part of the housing market is owner-occupiers refinancing, upgrading to a bigger house, moving to a different house, and we've seen both investor demand and that owner-occupier demand up significantly in the last 12 months. So it's very hard for central bankers to focus on first homeowners. That's going to rest at the hands of state governments. It remains, I guess, perhaps a social question rather than an economic question in the medium term.
Next question, John. You did speak about the Australian dollar. In the longer term, what are your expectations for where the Australian dollar is heading?
80 cents. 80 cents on the currency with, long-term value 75 to 80 cents, somewhere in that range.
So the current level 90, you see that any time from the next 6 months to 3 years away?
Well, next 6 months, I actually think the dollar will probably stay in the early 90s. I can't see it going above 95. predominantly because the RBA has taken itself out of the equation for the next 6 months. It's going to need 6 months of more data to have our view challenged that we think things are getting better. If things are not getting better, then a rate cut would be on the cards. But the key driver of our call for the Aussie dollar to depreciate is what's happening on the other side of the equation is the US dollar. A strengthening US economy, interest rates at some point will start to be lifted. That's going to put pressure on the Aussie dollar, and we'll see it well below 90.
Interest rates are very important for both business owners, investors, anyone looking to purchase a home. So could you tell us a bit more about the outlook for interest rates and, people thinking about whether it's buying a term deposit, buying a house at a fixed rate mortgage, or making a business decision? Where do we see both the interest rates in the short term, 2014, and then when do we see them either increasing or decreasing from then?
I think we're in a period where we're going to see interest rates still low by historic levels for a good number of years. Inflation expectations remain very well anchored. You've got surplus capacity here in Australia, so just don't see, notwithstanding tradables inflation, which I think the RBA will ignore, just don't see a period where we're going to get strong inflation here to force the RBA into lifting rates into a restrictive setting. So I think, as we said, for 14, rates are on hold. That's perhaps the easier of the two parts of your question, David. The more harder part is what happens in 15 and 16, and I think 15 we may see interest rates start to rise, but I think it's going to be quite gradual. I don't think we're going to see these sharp appreciations of rates like what we've seen in the past, simply because of some of the demographic challenges and simply because of the pace of a recovery here in Oz and also in overseas is still going to be a relatively slow pace of recovery rather than really off to the races like what we've seen in prior years.
We are out of time now, so that'll be it for questions today. Thank you, John, for sharing your thoughts with us for today. Now, I all hope that all the webinar attendees got something out of today, whether it's some thoughts for their investment portfolio or indeed where they take their business in 2014. If all attendees wanted to watch that in their inbox, there will be an email through from the Chamber of Commerce with a copy of the recording and the slides and some special offers for Wilson HTM.